All right, this is a bit of an explanation in terms of material from Chapter 3, which looks at cost volume profit analysis. All right, now turn off my phone here a little bit. Okay, so we're going to take a look at what is cost volume profit with break even. What is break even? Why is it important? We're going to look at target income, target net income. How do you use it with respect to leverage, etc. All right, so I'm a little too fast here. Okay, so let's just use the down arrow. All right, CVP is just a simplistic way of making a discussion about, well, what happens to net income? For the reasons we talked about, there are particular numbers that managers are very concerned about. And one number of obvious concern to them is net income. So if the question comes up, well, if we do this, if we do that, what will happen to net income? And CVP is just another way of saying, okay, if we make this change, if we incur this cost, if we do this or do that, what impact will it have on sales? And what impact will that have then on net income? Because net income is ultimately the measure of greatest interest both to investors and to managers. So CVP is just another way of helping you understand what's going to happen to that net income figure. All right. This I'm not going to spend too much time on, the 5-step decision-making process. But understand that the issue is to, number one, identify the problem. And that is often one of the biggest challenges, because a lot of times we assume that we know what the problem is, but in fact we really don't. And so it's very clear, it's very important in real life that you sit down, you talk with people, that you don't make assumptions. They're not making assumptions, that the information is being clearly communicated. This is the problem. This is what we need to address. Obtaining information, how good is the information? And really what we're doing, all of this is about, okay, we're going to make a certain prediction about what's going to happen in the future. There's going to be a degree of uncertainty. We're never going to have perfect information. We can't make perfect decisions. So can we mitigate some of the uncertainty, and or can we identify how much uncertainty there is? But at some point, you have to make a decision. You have to decide, okay, this is what we're going to do. This is what we believe is going to happen. And then you implement it, and then see what happens. All right, CVP is really based on a couple of things. One is that the world is made up of fixed and variable cost. And as I said the other day, from now on, pretty much throughout the rest of the book, we're not going to really look at manufacturing costs versus non-manufacturing costs. That's only done under generally accepted accounting principles, primarily because GAAP says, look, okay, all ordinary necessary costs to produce or to obtain an asset go into its cost. So quite naturally, manufacturing costs would go into it. But the problem with the manufacturing, non-manufacturing dichotomy is that it really doesn't help you as much in terms of making decisions. And in fact, it can lead you to a lot of erroneous decisions about what's going to happen if something changes. So what we're looking at here is the idea that, okay, we're going to make some assumptions that these selling price, the variable cost per unit, fixed cost, that they are known, we know them, and most importantly, for this period of time, particularly for a year, that those are going to remain constant. Now, most of our analysis will involve a single product, and looking at, well, what's the break-even point, what would be a target operating income, well, how many units do we have to sell, etc. And in most cases, this is short-term. Generally, we're looking at this over a period of less than a year. So it's okay generally to ignore the time value of money. Time value of money is nice from a very technical point of view, but it involves and increases a lot of complications into the calculation. Contribution margin is defined as simply revenues minus all variable cost. And when I emphasize the word all, I mean that. And that is all means whether those variable costs are a function of manufacturing or maybe they're incurred in the corporate headquarters, it doesn't matter. If it's a variable cost, it's subtracted and getting to contribution margin. Contribution margin is, in a sense, what's left over to pay for fixed cost. Once fixed costs are paid for, then the contribution margin represents your profit. The contribution margin per unit, which I showed on the board, that represents, in a sense, your incremental profit. So for every unit I sell, if I go from 10,000 to 10,001, my contribution margin per unit is my incremental profit. So if I'm below the break-even point, every time I can sell one more unit, okay, I'm reducing my overall loss. That's good, okay? If I'm selling above the break-even point, then the contribution margin per unit represents my incremental profit. The contribution margin percentage is just the contribution margin divided by the sales price per unit. So if we're selling an item for $10, if the variable costs are 6 and the contribution margin per unit is 4, we're assuming that remains constant, then my percentage here is 40%, which means that for every dollar of sales, there's 40 cents left over to pay for fixed cost, and then beyond fixed cost, that would go towards profit. The cost volume profit, basically, this represents my revenues. See if I can do this nicely, neatly, okay? Selling price times the quantity. So the basic formula is revenues minus variable cost, okay? That is the unit variable cost in total times the quantity minus my fixed cost equals my operating income. Okay, which everybody pretty much remembers and knows. It's not a huge issue. So the book will play around with a little bit of the algebra here with this. At the break-even point, basically what I'm doing, the basic formula is to say at the break-even point, my contribution margin will equal my fixed cost. Okay? My total contribution margin will equal my total fixed cost. Now, if I wanted to calculate the break-even point in terms of units, okay, is simply taking the fixed cost divided by the contribution margin per unit. So, for example, like I said yesterday, if you have fixed cost of 40,000, contribution margin per unit of $4, then it means I would have to sell 10,000 units in order to break even. That's my break-even point. Below 10,000 units, I'm losing money. Above 10,000 units, I'm beginning to earn a profit. Then I could take the 10,000 units times the sales price, and I could get the break-even in terms of sales or revenues. Generally, for decision-making, people tend to emphasize units. It tends to be a little bit easily understood. And marketing people tend to talk in terms of, well, we have to achieve a certain unit of sales. Break-even can be arrived also in terms of revenue by taking the fixed cost and dividing it by that percentage. So if I go back to my original example, if this were 40%, take the 40%, divide it into 40,000, and I would end up with $100,000 of sales or revenues at the break-even point. So a break-even point is a relatively simple thing to calculate. Now, what's it useful for? Well, it's a way to assess the risk. If a new product is proposed, then the engineers, the accountants will look at how the costs break out determine the break-even point, let's say 10,000 units per year. Then the next question that would come, or that would be pointed towards the marketing people, well, what's the probability that we can achieve that? Well, okay, if it's 70%, that would be fairly acceptable, so it would be acceptable. They would go for it. If the probability is only maybe 30% that we can achieve that level of sales, then it would be a no-go. We're not even going to do it. So it's a way of assessing risk. It's a way of kind of a quick and dirty way of saying, okay, this is a product that we want to pursue, or no, this is a product we're not going to pursue because there's no profit in it. Now, most companies are not in business simply to break even, to tie. So as I talked about yesterday, I have that example where, you look at the contribution margin income statement, which basically starts with revenues, subtracts out variable cost in terms of total. Okay, so here's my total contribution margin. Then I subtract out my total fixed cost, and what I'm left with is my operating income. Operating income is simply what's left over after I've taken revenues and subtracted out both variable and fixed cost. Well, there's one other step, and that is after operating income, I need to subtract out my taxes. So once I subtract taxes from operating income, I'm left with net income. So in terms of target profit planning, in a sense, we're starting from the bottom and working up. In this case, we're ignoring taxes. We're just simply saying, okay, we want to achieve a target operating income. And by the way, you need to be kind of careful as you look at these problems to make sure you distinguish between operating income and net income. And so in this case, I simply add that target operating income because that's the only thing that I can really control. Once I get to the target operating income, then taxes are an automatic. So I add it to fixed cost and then divide that by either the contribution margin per unit or contribution margin ratio. For most of the problems you're going to be doing, this target operating income will be given to you. So it'll say, okay, my fixed costs are $40,000. If I want to earn an additional $40,000 of operating income, if my contribution margin is 4, that means I have to have a level of sales of 20,000 units. So that's pretty much it in terms of operating income. And here's just an example of them doing that, okay? All right, now, again, they're taking the sum of these two. You can divide it by the ratio. You can divide it by the contribution margin. All right. And again, graphically, it's never a bad idea to present this to people. The break-even point is where the revenue line, which always starts at 0 because of 0 sales, I have 0 income coming in. And I'm assuming that my total costs are always going to be a mixed cost. And that is, there's going to be a certain amount of fixed, there's going to be a certain amount of variable. So it's going to start at some point. This area, as they indicate, is the loss area. I'm losing money. But every unit I sell moving in this direction is increasing my profit. So even if I'm operating at loss, okay, if I can go from 15 units of sale to 20 units of sales, I'm increasing my profit. Likewise, beyond the break-even point, I'm into the profit area. Obviously, I don't want to move in that direction because that means that I'm actually losing. I'm sliding down here. I'm losing my operating income as I move in the opposite direction, if the slope is since negative. All right, now, in real life, investors and particularly investors demand a certain net income, and that is they want a certain return on their investment. So management's very cognizant of that. So what they take into account with a particular product, and we're looking at this from the point of view of an individual product, it has to achieve a certain net income. And so just like we talked about before, you'll have a certain amount that's given in terms of sales price per unit, variable cost per unit, fixed cost, etc., and assume a tax rate. And so the problems will always give you, went too far here. Okay. The problems will give you what would be called the target net income. So be careful with that. So again, if I'm looking at this from the point of view of an income statement, I need to move from my net income, okay, which would be here, okay, and move up to my operating income, okay? And again, kind of fill in the blanks in terms of that. This right here would be my tax, okay? See if you can read that, okay? That's my tax that I'm paying. So if this is my goal to achieve that, then I have to achieve a certain operating income. Because once I get to the operating income, then the taxes are automatic, for less 40%. So the way I do that algebraically is taking the net income, okay, to get at my operating income, because this is what I want to achieve. I start with this target net income and divide it 1 minus the tax rate. that will give me the operating income that I would have to achieve in order to uh, earn that. Then, once I have the operating income, now I can plug that back into that basic formula, take the operating income, add it to the fixed cost, and then divide it by the contribution margin. That will give me the unit sales, okay, and then I can also figure out the revenues that I would need to achieve to earn that. And then I have the solution. That would give me the number of units. And if you want to prove it, you can work through the income statement and you'll end up with this in that income that you desired. So it starts with, if you want to kind of visualize it, as I said, create the contribution margin income statement. So with target net income, you're basically working your way back up to that operating income, plug it into that basic formula of fixed cost plus operating income divided by contribution margin, gives you the unit sales that you need to achieve in order to earn that net income. Now, profit planning is just another way of running a number of different scenarios. So sensitivity analysis, saying, well, what happens if I change the variable cost? What happens if I change the sales price? What happens to my profit? So you're kind of running through a number of different scenarios, fixed costs, et cetera, to see what happens with that. We're not going to make a huge issue with that because, again, it's just simply a matter of crunching numbers. But understand, what is sensitivity analysis? Why do I do it? It's being done to say, well, if for some reason this changes, what's going to happen to our profit? How do we respond with that? Margin of safety is simply the difference between the break-even point and the budgeted level of sales. Or it could even be, well, where are we in terms of sales now? Typically, it's done from a budget point of view. So if the break-even point is 10, and if you're selling 15 units, then your margin of safety is 5 units. Now, again, that's not really as easily understood. So more often than not, the margin of safety will be expressed as a ratio. And if I go back to my simple example, if my break-even point is 10 and my margin of, and my budget of sales are 15, then I know my margin of safety is 5. I take that 5 divided by 10, and so I say, okay, I have a 50% margin of safety. And again, what it means is that my sales could fall by 50% before I would hit that break-even point and begin to lose money. So again, the higher the number, the less risk there is. I could also talk in terms of marginal safety. Well, my sales would have to decrease by 5 units. But again, if I'm comparing different products, their marginal safeties are going to be different. So it's hard to kind of make a sense of, well, which is more risky, which has a lower margin of safety ratio. So ratio is always an easy way of kind of making different products, different items equal in terms of analysis. Now, cost structure is looking at this issue of leverage, the mix between fixed and variable cost. For a lot of reasons that I talk about, companies make strategic decisions in terms of, well, we're going to be heavy in variable cost or we're going to be heavy in fixed costs. It's not necessarily right or wrong. They're looking at the environment, they're looking at the risk, they're looking at a number of different number of different items, and they say, okay, this is the way we want to structure things. Now, just like we talked about in terms of debt, you can have financial leverage, which means you have a lot of debt, heavy leverage. That can be good, it can be bad, depending on the situation. The problem is that if you take on a lot of financial leverage, as kind of common sense, the more debt you take on, the more fixed payments you take on. That fixed amount of interest and principal becomes very, very large. Now, if your sales, if your income is sufficient, you can pay it off, and then what's left is yours. The problem is if your sales begin to fall, if your revenue begins to fall, then, or your income, from a personal point of view, falls, then you're in trouble. You can't make those payments. And you have to make them. There's no ifs, ands, or buts about it. Well, to a great extent, the same thing is true with operating leverage. The more fixed cost I take on, and of course the answer will be, the question would be, well, why would I do that? Well, if I use more machines, I can churn out more products. I can maybe improve quality. There are a lot of different reasons why I might want to do that. But again, I'm taking on, the more fixed cost I have, the more fixed payments I have. So if my sales are increasing, if I can maintain them at a very high level, then yes, I'm making money. But if they begin to fall, then no, I'm in trouble. Operating leverage is simply taking the contribution margin of where I am or where I think I'm going to be if I'm budgeting this and dividing my operating income. Okay. The higher the number, the more fixed cost you have. Okay. Because this is, as you take on fixed cost, the operating income will go down. If my fixed costs are significantly less, then my operating income will go down. Because remember, contribution margin is what I have left after I pay for my variable cost. Okay, and the more fixed cost I take out, the more operating income I got to take on. All right, so it's simply a number, a ratio, if you will. Well, okay. So what's the significance of it? Well, if you calculate that, let's say in our example here, you come up with an operating leverage ratio of 1.67. That is taking the contribution margin and dividing by operating income. Well, what it means is that no matter what I do, okay, if I take this operating leverage, I can multiply it times the percentage of sales, and that's the amount that it will magnify it. So if next year, if I know that right now, and I'm going to maintain this leverage ratio, it's 1.67, if my sales are increasing by 50%, then it means that my operating income will increase by 83.5. Leverage is a way of also saying magnification. My operating income will be magnified over and above what the sales level would be. Now, as long as you're on the positive side of the break-even point, this is great. Operating leverage will increase your profits substantially. There's no question about that. But you're taking a big risk because the more fixed costs you're taking on, the higher your break-even point is going to be. So if you can maintain that, you're making a lot of profit. The downside is, unfortunately, if your sales begin to go down and you fall below the break-even point, then your losses magnify substantially. So this leverage ratio works both ways, both on the positive, if you're above the break-even point, and the negative, if you're below the break-even point. All right. Now, sales mix, unfortunately, the slide doesn't do a good job of explaining that. But remember, with sales mix, okay, you're going to take the contribution margin for each particular product, let's say A and B, and then the most important part of that is the ratio of sales. That's the other constant. So no matter what that ratio is, and that's often the big challenge, is determining that ratio. You take the contribution margin times that ratio, let's say it's 3 to 2, well, take the contribution margin of A times 3, contribution margin of B times 2, that will give you the total contribution margin that you would get for each bundle or each basket of goods. Because when you have multiple products, the assumption is the company is selling a bundle, a basket of goods that includes, for example, 3 units of A, 2 units of B. And then the second bundle, 3 units of A, 2 units of B. So I'm looking at the contribution margin that's in each bundle, or each basket. So if I take that total contribution margin per basket, and then now I have my contribution margin, I can divide that now into my fixed cost plus my target operating income if I want to do that. Now I can figure out, well, how many bundles or baskets do I have to sell to break even point? All right, I get that number. Then I take that number, multiply it times that ratio, 3 to 2. So for example, if my break-even point in terms of bundles was, say, 10,000, well, okay, fine. That's how many bundles I have to sell. I take the 10,000 times 3 because that's the ratio for A. So that means I'm going to sell 30,000 units of A. Take that times 2 for B. I'm going to have 20,000. So my total units, A and B, would be 50,000. But it's predicated on the fact that I'm maintaining this ratio and I'm selling 10,000 baskets of goods. Yeah, this can be applied to a lot of different, it's not just for manufacturing. CVP can be done in a lot of not-for-profits. All right, we're going to be not so much in this chapter because we're focusing in. Okay, gross margin you guys are used to. But here again is the contribution margin format, okay? Where I have my, notice what they're doing, taking the total sales minus my variable manufacturing, my variable non-manufacturing, and that's fine. This gives you a lot of good detail in terms of what's what. But contribution margin is, by definition, what's left over after I paid all my variable costs. Again, they're doing the same thing with fixed costs, differentiating between manufacturing and non-manufacturing. Fine. What I end up with is my operating income. So the contribution margin format allows you then to kind of look at incrementally, well, as sales change, what happens to income? A lot better than does the gross margin method. All right, terms, etc. Again, I'm not going to test you on terms. Make sure you understand what they mean so that as you're going through the homework, if you're looking at quiz questions, etc., you're very clear about what they mean.